The government never sent you a letter explaining this. Most retirees only find out on tax day, when it's already too late to do anything about it. Your Social Security income can be taxed up to 85%, and the system was built to pull people in quietly. Here is something that gets buried in the fine print that nobody reads before they retire. Social Security was sold to generations of American workers as a retirement benefit they had earned through a lifetime of payroll contributions. You paid into it every single year you worked. Your employer matched those contributions alongside yours, and the promise was that when the time came to step away from the workforce, that money would be there waiting for you, a guaranteed income stream funded by your own labor and your own sacrifice. What nobody put in the brochure is that in 1983, Congress passed a law that allowed the federal government to impose income tax on Social Security benefits for the very first time. Then in 1993, a second law raised the maximum taxable portion from 50% up to 85%. The income thresholds that were established back then to determine who would pay this tax have never once been adjusted for inflation. Not in the 90s, not in the 2000s, not in 2015, and not today in 2025. So every year that goes by, more retirees get dragged across those thresholds, not because they became wealthier, but simply because ordinary living costs have gone up while those numbers stayed frozen in time. When the IRS says up to 85% of your Social Security benefits can be taxed, what they mean is that up to 85 cents of every dollar you receive can be counted as taxable income. The actual tax you owe still depends on your federal tax bracket, but the key point is that the amount of your benefit exposed to taxation is determined by a formula most retirees have never seen until they are already sitting in their accountant's office trying to figure out why they owe money in April. So let's walk through exactly how that formula works, because once you see it clearly, everything else in this video is going to make complete sense. How the tax works. The IRS uses something called provisional income, which is also sometimes referred to as combined income, to decide how much of your Social Security benefit gets taxed each year. The formula works like this. You take your adjusted gross income for the year, which includes any withdrawals from a traditional IRA or 401k, any wages you still earn, pension income, capital gains, rental income, and any other taxable sources of money you received. To that number, you add any tax-exempt interest income you received during the year, which in most cases means income from municipal bonds, and then you add 50% of your total Social Security benefits for the year. When you add all three of those together, the result is your provisional income. Here is what happens depending on where that number lands. If you are a single filer and your provisional income falls below $25,000, none of your Social Security benefits are taxed at the federal level. If it lands between $25,000 and $34,000, up to 50% of your benefits can be included in your taxable income. If your provisional income exceeds $34,000, up to 85% of your Social Security benefit becomes taxable income. For married couples who file jointly, the thresholds shift slightly. Up to 50% of benefits can be taxed when provisional income sits between $32,000 and $44,000, and the 85% tier kicks in above $44,000. Here is the part that catches so many people completely off guard. A retired couple with a modest pension, a few $100s a month in traditional IRA distributions, and their combined Social Security checks can very easily push past that $44,000 threshold. These are not people with lavish retirement incomes. These are ordinary retirees living on exactly what they plan to live on. And they're still paying this tax because thresholds that were written into law in 1984 and 1993 were never once updated to reflect the cost of living that any of us actually deal with today. But here's where the conversation gets much more useful, because the provisional income formula has variables, and variables can be managed. There are strategies that retired Americans are using right now to legally and significantly reduce how much Social Security tax they pay each year. Some of them eliminate it entirely. Here are the 4 most effective ones. Strategy 1: Roth IRA conversion. The single most powerful tool for reducing Social Security taxation is the Roth IRA conversion, and the best window to use it is often in the years before you ever collect your first Social Security check. Here's why this strategy works so well. Every time you pull money out of a traditional IRA or a 401k, that withdrawal gets added directly to your adjusted gross income, which feeds straight into the provisional income calculation and pushes more of your Social Security benefit into taxable territory. Roth IRA withdrawals work in an entirely different way. Qualified distributions from a Roth IRA are not counted in the provisional income formula at all. They're completely invisible to the IRS's Social Security tax calculation. So the approach is to convert portions of your traditional retirement accounts into a Roth IRA in the years before Social Security begins, ideally during a period when your income is lower and you can absorb the conversion tax at a more favorable rate. When your Social Security income starts and you need to pull money out for living expenses, using those Roth funds instead of traditional account withdrawals means you are not inflating your provisional income and not triggering additional taxation on your monthly benefit. Done strategically across 3 to 5 years before benefits begin, Roth conversions have the documented potential to save households tens of thousands of dollars in lifetime tax liability tied specifically to Social Security income. Strategy 2. Qualified charitable distributions. The next strategy is one that most retirees have never heard of, even though the IRS has made it available for years. It is called a qualified charitable distribution, commonly referred to as a QCD. If you are 70 and a half years old or older and you have a traditional IRA, you can instruct your IRA custodian to transfer money directly from your account to a qualified charitable organization. When that transfer goes directly from the IRA to the charity without ever passing through your hands, it is never added to your adjusted gross income. For 2025, the annual limit on qualified charitable distributions is $108,000 per person. If you are already planning to make charitable contributions of any kind during the year, redirecting those dollars through a QCD instead of writing a personal check is almost always the smarter financial move. You reduce your adjusted gross income, which reduces your provisional income, which can pull you below the threshold where more of your Social Security gets exposed to federal taxation. And you still accomplish exactly the same charitable giving you were going to do anyway. Strategy 3. State tax considerations. One factor that many retirees overlook until they are already settled into a location is where they actually choose to live in retirement. While the federal government taxes Social Security under the provisional income rules we just described, each state government is an entirely separate matter with its own rules. As of today, approximately 41 states and the District of Columbia do not impose any state income tax on Social Security benefits whatsoever. States like Florida, Texas, Nevada, and Wyoming have no state income tax at all. Others like Pennsylvania and Illinois specifically exempt Social Security income even while taxing certain other forms of retirement income. If you currently live in one of the states that does tax Social Security benefits and you have any flexibility in your retirement plans, researching the full picture of how your state treats retirement income could represent a meaningful financial advantage over the course of a 15 to 20-year retirement. State taxes stack directly on top of federal taxes, and for some retirees, the combined effect is significant enough to genuinely change the retirement math in a serious way. Strategy 4. Income timing and source management. Finally, one of the most underused approaches to reducing Social Security taxation is simply paying close attention to the timing and sourcing of your income within each tax year. Because traditional IRA and 401k withdrawals are the biggest single driver of provisional income, retirees who have access to multiple income sources, including a Roth account, a taxable brokerage account, or both, have real flexibility in which accounts they draw from in any given year. In years where your income from other sources is already elevated, leaning on Roth withdrawals or after-tax savings to cover expenses, instead of triggering traditional IRA distributions can keep your provisional income below the threshold that sends more of your Social Security check into taxable territory. This kind of year-by-year income management is most effective when it's planned well in advance and reviewed with a CPA or a retirement-focused tax professional who understands how all of these income sources interact interact with the Social Security tax formula. But the core idea is not complicated at all. Every dollar of traditional IRA withdrawal you can replace with a source that does not count. Toward provisional income is a dollar that protects more of your Social Security benefit from taxation. Social Security taxation is not a fixed outcome you simply have to accept. It is a formula, and every formula has variables you can influence if you understand them. The retirees who keep more of their Social Security income are not necessarily the ones with the lowest total incomes. They're the ones who understood how the system actually works, made deliberate decisions about their accounts and income sources ahead of time, and took steps long before the first benefit check ever arrived in their mailbox. If this video gave you something genuinely useful, hit subscribe because we cover this kind of specific retirement tax information every single week right here on this channel. And if you have questions about any of the strategies we walked through today, drop them in the comments below. We read every single one.